this week?
Well, first of all, it shouldn't really be that surprising, both because obviously the kind of momentum we'd built up was the kind that was bound to start to decline. If you look at the incoming data, the city surprise index, our own Bloomberg surprise index, is now very sharply negative for the first time in over a year. So the actual incoming data is weakening compared to what we'd come to hope. So it makes sense to downgrade forecasts. And then there is a surprisingly lively debate over whether Delta matters. In that it strikes me as fairly straightforward that Delta is a pretty good reason for growth to be somewhat disappointing or to be trimming back what you're expecting for growth. And that hasn't actually been cited as a reason by the likes most famously of Goldman, the various people that are downgrading their forecasts.
You're right. And actually what's interesting to me is what instead they are highlighting. And again, it's policy uncertainty. It's the fact that perhaps something won't get done. Maybe the debt ceiling will become a real issue. These are the issues that people are pointing to way more than Delta. And just to sort of edify that point, the airlines came out and downgraded their expectations for earnings, with some saying that they weren't going to earn anything. They're to keep losing money because people are canceling trips. And people bought their stocks. I mean, honestly, it's sort of, this is not the issue that seemed to be causing some of the weakness.
Yes, and that is strange because that is a really good reason to be less confident about stocks than you were compared to 3 months ago. Plainly, most of our base case scenario of recovery per se from the pandemic is looking worse than it did. This was the week we were supposed to be well and truly back in the office. I'm still at home, as you can see.
With your robust bookcase, love it.
With my robust bookcase and my robust 12-year-old son darting around in the background, yes. And
playing Minecraft.
and this is, yes, indeed he is. And that is, that's not what we were expecting. We really did think that this was going to be the back to normal week, and it isn't.
Right. Which raises a question of why markets have held it as well as they have, right? I mean, basically people were saying, wait till September. Now people are saying, maybe wait till October, maybe later. It doesn't really matter. And it really raises this issue of, is it just a central bank put? And it's not just the Federal Reserve, but also the ECB.
Yes. Well, in the case of the ECB, it's fascinating how well they've handled their communication. So in answer to your question, I'm not sure if it's just a central bank put, because earnings on stocks have been very good indeed, and they're not being trimmed back much at all thus far. But it's primarily a central bank put. It's primarily the TINA argument. There's no alternative while rates stay as low as they are. What is very interesting, the latest development on Thursday, is the ECB, in terms of the PEP, its specific pandemic emergency purchases. It is saying definitely that it will be making fewer of those purchases in the fourth quarter than it did in this quarter. So that is a taper, as we've come to describe it.
No, it's not. Christine Lagarde said it wasn't. So how could you use that? Go on.
And what's remarkable is, my inbox is full of all these people who don't believe a word Christine Lagarde says and tells me, spend months saying how she has no credibility, and everybody believes, or judging by what they're doing with their money, believes her when she says it isn't a taper, which is very, very startling.
Look, ultimately, does this just become a tautology, right? Because they are going to reduce their purchases. However, they're still going to buy enough to cover the entirety of all sovereign debt issues in the European Union. So it's not exactly like people are going to be lacking for their put or their influence in markets, right? So, and let's be clear, they were planning on ending the PEP program at some point anyway, in the near future. So they have to start winding it down. The issue that I have is what could potentially call the hand of some of these central banks, because they are being successful in saying taper without saying taper. They're being successful in removing some of the extraordinary bond purchases without causing any disruption at all. At what point is there a disruption? And I'm thinking a lot about this. I have an answer. I'm curious about yours.
Okay, there are various possibilities that we haven't foreseen, and obviously the anniversary of 9/11 coming up. None of us foresaw that, but barring something that we can't foresee, that we can't really talk about, my one answer to that is inflation. At some point, and we don't know what it is, and we don't know whether it'll happen, you get to some kind of a tipping point where people can see that this really isn't transitory, and that means that central banks either allow inflation to really take off again, or they withdraw the put, and neither is a good option. Now that would bring this environment to an end. There's a fascinating bigger debate which we might get into, I suppose, as to whether such a moment will ever happen, whether what inflation we have at the moment is transitory. Tell me your
Okay, I was going to go to the same thing, which is inflation. Yeah. We'll call the Fed's hand one way or another. But which inflation matters a whole lot? I mean, we got PPI data, the producer price index data, out this morning, and it was one of the fastest increases in product incoming input material costs that we've seen on record, right? I mean, it's incredible to see how quickly these prices are going up. And yet this isn't the inflationary gauge that the Fed looks at. And frankly, they probably shouldn't, because it's probably more disinflationary, because people are less inclined to buy a lot of stuff if the prices are that much higher, especially if their wages are not keeping pace.
Yes.
This is the question. I know you honed in on this week, the Atlanta Fed wage tracker, the idea of, well, how much are wages increasing? They aren't increasing as much as inflation, but they're starting to show a really interesting pattern. And the question is, could this lead to something more persistent that calls the Fed's hand and frankly disrupts markets, even if it's good for the underlying economy?
Well, my answer to your question is yes, it could. I'm not predicting with total confidence that it will, because so many things are so unclear. But if you want to, if we can have a quick look at the chart I had in last night's newsletter. What's nice about the Atlanta Fed is that they break down wage increases on all kinds of levels. They do it by gender, by age, education. And what we're looking at here is how wage rises have gone for the low skilled compared to the high skilled. And the low skilled wage increases have exceeded those for the highest skilled 3 months in a row. And since they started doing this tracker in 1997, that had only previously happened ever before in 2 months. So you plainly have some change in the nature of the demand for work, which is leading to the lower skilled people who've really had a dreadful deal. The wage inflation for those people was below 1% for 3 years under Barack Obama. And if you want one really good reason how Donald Trump was able to break the Obama coalition, that might well be it. People in the lower skilled jobs really had a dreadful deal for a long time. Logically, they would have a higher marginal propensity to spend. They'd be more likely to go out and spend. It would be good for growth, good for the health of the society in general. You would, again, logically think, though, that would be more inflationary, that the wage growth we're seeing may not be that high in totality, but it might be going to exactly the people that will help, A, grow the economy, but B, inflate prices.
Which is what we saw, frankly, when they sent out the stimulus checks, that individuals that earn the least spent the greatest proportion per dollar of what they got in from the federal government, just to sort of edify that point. So I wanted to sort of point out this dichotomy between the input prices that have been increasing and wages, and how different the trajectories have been. Seth Carpenter of Morgan Stanley, the chief economist there, was on Bloomberg Surveillance this week, and he was saying he thinks we've seen the peak in terms of the inflation in CPI and PPI. He thinks that the supply chain disruption is going to start working through themselves, and we're going to start to see some normalization. He doesn't think we've necessarily seen the peak in wage inflation. And this to me is interesting. And I guess the thing I'm struggling with is the time frame that people have to get a job at these higher wages before this imbalance, sort of upper hand that workers have, sort of gets eliminated to some degree. And I think about what Peter Scheer was talking about of Academy Securities, where he was saying, the longer we wait, the more some of these jobs are going to dry up. I'm thinking of the 11 million job openings that we have out there. For as long as we're in this paradigm where people still have savings, we can see what we're talking about, which is the fastest increase in the lowest income workers relative to higher income workers that we've seen going back to the 1990s. But as this continues, companies are going to find other solutions. And this to me is sort of the tension right now. Are companies going to end up with lower margins, or are they going to end up paying employees more on a persistent basis, a persistently increasing basis, which leads to some sort of virtuous cycle of good inflation that the Fed's been looking for?
That's a very interesting. It's interesting. I haven't heard that argument put that way before. To some extent, the argument from the point of view of you are a person considering going back to work who's previously been in a pretty low wage, low skilled job where you really wondered in the last year, was it worth doing that boring job for that wage? Was there really any great dignity in that? What the argument would be is you'd better take something soon on a pretty good deal, or you're going to lose out to a robot. They're going to work out a way to do without you.
Right.
If that works out, that is a very interesting argument for transitoriness. I wonder how long it takes you, however. A lot of the low-skilled jobs in the economy would have gone already, given, if it were possible. It takes time to eliminate such a job. I'm not sure how long it's going to be before everybody orders McDonald's on. I don't order McDonald's anymore, but I used to. But but
you digress.
whether you're going to order McDonald's from a robot online anymore, or whether you are still going to basically be walking down the street, go past a store and want to buy it. I still think it's going to be quite. We've automated to a very great extent, and we've been left with this big residue of fairly low paying but necessary low skilled service jobs. I'm not sure how easily you can get away with them, but this is a very interesting argument that I haven't engaged with before. I'm talking off the top of my head.
Well, no, but you're talking well, because honestly, these are the issues. On the flip side, if we can't see that virtuous cycle, right?
Yeah.
I mean, if we can't see this sort of increase in wages and companies more willing to pay a greater proportion of their profits to workers, which frankly, that's been falling for decades, yes. Right? Well, then it goes to this slower growth argument. Does inflation prove itself its biggest enemy to inflation? That basically the higher prices go, the less people pay, the more dynamism is taken out of the economy and things slow down. And
Yes, then you get the stagflationary argument, because it's
I don't want to use the S word. They're just going to make fun of me. But, staglight, whatever you want to call it. Yeah. But that kind of feedback loop, which is what a lot of people were citing with the slowdown.
I don't see anything virtuous about a cycle that's created ultimately by things costing more. I mean,
Agreed.
And I think that the amount of discipline, the much maligned era of shareholder value of the last few decades of companies really putting the interests of shareholders first, now coming far more into question with ESG and all the rest of it in the last few years, but plainly has had a very big effect on companies and has made them more profitable. It's questionable to me how much further that can go. So therefore, any cycle caused by higher wages, higher input prices is going to be a vicious one. I
would tend to agree with that. Okay, we've got a minute left. So I, of course, totally timed this wrong, and we have very little time to talk about the underappreciated risks. So go ahead, quickly. What's your biggest underappreciated risk of the week?
Okay, underappreciated risk. The story this morning, Kroger share price is down 8% because they have a big problem with their supply chains, which they say in large part is because of organized crime. It's absolutely the definitional company everybody bought because it was safe during the pandemic. I'm very startled to have discovered this.
Well, the whole idea of shipping is a very tangible and human endeavor, and it can be subject to a lot of other unknown variables. What I've pointed to is a Wall Street Journal article this morning about how increasingly crypto assets are being pledged as collateral against personal loans. So basically, if you have a lot of crypto assets, your eyes are gold, by the way. If you have a lot of crypto assets and you don't want to have to sell them because you might think that they appreciate, you want to hold them for the long term, you just stick them in one of these sort of shadow banking types of entities, get some cash and pay down your student loans or go buy.
But if you want to borrow anything from me, I'm not taking Bitcoin as collateral. But
good to know. The John Authers public service announcement of the day. Thank you. It is officially 11:45, so we're out of time.